This question is related to cost of capital. Kalyanam Limited has an operating profit of 34,50,000, that is 3.45 million, and has employed debt which gives total interest charge of 750,000, that is 7,50,000. The firm has an existing cost of equity and cost of debt as 16% and 8% respectively. The firm has a new proposal before it which requires funds of 75 lakhs and is expected to bring an additional profit of 14,25,000. To finance the proposal, the firm is expecting to issue an additional debt at 8% and will not be issuing any new equity shares in the market. Assume no tax culture. You are required to calculate the weighted average cost of capital of Kalyanam Limited before the new proposal and after the new proposal. So first of all, how do we calculate weighted average cost of capital? We take equity, we take debt, we total them, then we find the proportion of the debt with total, we find the proportion of equity with the total, and on that proportion we will multiply the respective cost of capital. That is, cost of debt is 16%, cost of equity is 8%. Then we get weighted average cost. Okay, here you are directly given what is the cost of equity, that is 16%. You are directly given what is the cost of debt, that is 8%. But the question is, what is the equity amount? What is the debt amount? Is it given directly? Answer is no, because you are told that cost of debt is 16% and you are also given information about the interest charge, which is 750,000. I'm sorry, you are given that cost of debt is 8%, not 16%, 8%, and you are given that interest charge is 750,000. So if you capitalize 750,000 divided by 8%, you will get the value of debt. Then how do we find out the value of equity? You are given operating profit. Operating profit is basically profit before interest and taxes. So from this, if you deduct the interest, you get the profit before tax, and question says no tax culture. So that becomes profit after tax, and that becomes profit available for equity shareholders. So if you divide that profit by cost of equity, in this case it is 16%, you will get the value of equity. Okay. So in this way, you can find out what is the what is the value of debt, value of equity using this information. Then we can find out what is the weighted average cost of capital before the new proposal. After the new proposal, what is happening? That is, they want to infuse 75 lakhs, that is 7.5 million, only through debt, and that will drive a profit of 14.25, that is 1.425 million. Already they have a profit of 34,50,000, that is 3.45 million. With that, this will get added. Okay, so this is the operating profit. From that, we have to deduct this interest, the old interest, as well as the new interest. The new interest is this 75 lakhs multiplied by additional debt at the rate of 8%. So that will give you profit available for equity shareholders. Okay, and if you compare that with the overall equity capital, you will get to know what is the new cost of equity. Then finding the overall weighted average cost of capital after the new proposal also becomes very simple. Okay, first let's do our workings. We'll have our working note number 1, where first we'll find out what is the value of debt. And how we are going to do value of debt? We take interest, right, and we divide that interest by cost of debt. So what is the interest amount? We know interest is 750,000. This information was available in the question, and the cost of debt is 8%. So I write it as 0.08. And what we get? We get 93,75,000. That is 9.375 million. And this is the value of debt. Okay. Value of debt is 93,75,000. Next, let me take you through value of equity. How we are going to do that? It's very simple. We are given operating profit is 3.45 million, that is 34,50,000. From that, let us deduct interest of 750,000. So we get profit available for equity shareholders, which is 2.7 million, that is 27 lakhs. Now this profit available for equity shareholders, if it is divided by cost of equity of 16%, then you will get the value of equity, which is 1,68,75,000. 16,000. It is 16.875 million. Okay. So in this way, we have derived the value of debt. Let me put it here. Value of debt here. We have also derived what is the value of equity. Then finding the weighted average cost of capital before the new proposal is very simple. We'll do it here itself. So we'll have the statement computation of weighted average cost of capital before the proposal. Our sources are equity and debt. Let me capture the amount. Equity we have calculated here and debt so much. So let's total this. Okay. Now we have to give weightage. Let's give the weight now. How do we arrive at the weight? Take the source amount divided from total. Okay, you get 0.6429. Okay, we call this as weight. The same way, take the source amount divided by total and keep it up to like 3 decimals. Okay, right. Now what we have to do? We have to bring out the respective cost of capital. Cost of capital. We know cost of equity is 16%, so we write it as 0.6, and we know cost of debt is 8%, so we write it as 0.08. Okay. Now, if you multiply this weight with cost of capital, you get weighted cost of capital, and if you total that, what you get is weighted average cost of capital. So, it is 0.16 multiplied by this weight, you get some value. Okay. Let me put it here. Yeah. Or I'll keep it as 3 decimals. The same way we'll do it here. Okay. And now let us add these two. Let us add these two, and what we got is 0.131. Let me extend one more. It is 0.1314. So we can say weighted average cost of capital before proposal is nothing but 13.14%. Simple. Now we have to find out what is the weighted average cost of capital after proposal. So that requires another set of workings, because the entire new funds are coming in the form of debt. Okay. And there will be some impact on profit available for equity shareholders. As a result, there will be impact on overall weighted average cost of capital. Okay, let's do that. We'll have working note number 2. So this is with regard to computation of total debt. So already there is old debt. We know what is the value of old debt. We have derived already, right? It was so much. And for funding the new proposal, how much they are bringing in? It is 75 lakhs. The firm has a new proposal which requires a funds of 75 lakhs. So we'll put that new debt is equal to 75 lakhs. Okay. Now let's total this. So we get the revised value of debt here. Okay. Now this looks exactly like equity. So this is our total debt now. And of course we know equity, but there is no change in the equity. Okay. And we should also find out profit available for equity shareholders. Computation of profit available for equity shareholders. See, because of this new project, what is happening to the operating profit? Operating profit. There is a old and there is a addition, right? Already they have a operating profit of 34,50,000, and because of this proposal, there will be an additional profit of 14,25,000. So it is 34,50,000 plus 14,25,000. So if we add this, we'll get our new operating profit. From this operating profit, we have to deduct interest, right? We have to deduct interest. But again, interest, there is old interest and new interest as well, right? Old interest, we know it is 750,000. What about the new interest? 75 lakhs at the rate of 8%. Okay. So it is 75 lakhs at the rate of 8%. So that works out to 6 lakhs or 600,000. and if we total this, we get to know what is the interest, and this have to be deducted. Let's do that. So from this operating profit, let's deduct this new interest and old interest. So we get 35,25,000. This is the profit available for equity shareholders. Okay. Now why this information is relevant? This is relevant because we have to compare this with the overall value of equity so that we can find out the cost of equity. Only then we'll be able to go ahead with weighted average cost of capital. But why we have not computed new cost of debt? It is same because old is also 8%, new is also 8%. Okay, so we don't have any issue over there. So let's do that. Computation of new cost of equity. This is after proposal. So what is the profit available for equity shareholders? It is this. And whether there is any change in the value of equity now? No, value of equity remains same. We have already calculated the value of equity. How? Let's go back to the workings. Here we had value of equity is so much. So profit available for equity shareholders divided by value of equity will give you cost of equity. Okay, so this divided by this. So that's going to give you cost of equity. Let's express that in percentage. So we get something like 20.89%. Done. And now we can go ahead and compute weighted average cost of capital. So let's do now. What is the value of equity? Before that, let me just correct this. This is after the proposal. Okay. What is the value of equity? Whether there is any change in the value of equity? Absolutely no. So this is the value of equity. Let me put it. Yeah, this is the value of equity. What about the value of debt? Yes, of course, the value of debt has undergone a change, and that is also now same as equity. So this is total debt. Okay, done. Now let's total this. Of course, it's 50-50 now. So the weight is like this, 0.5, 0.5. Okay. What about the cost of capital? The cost of debt is same, 8%, but cost of equity has undergone a change. Cost of debt is 0.08, whereas cost of equity we just computed here. Look at this. It is 20.89%. So I can call it as 0.209. Or here also I should express in percentage. Okay, let me put this in percentage. Either way, see, either way the result is same. Okay, so it is 20.89%, and if I multiply now, you get 0.104, and here it is 0.04, and if you total both, what do you get? It is 14.44, and how do we express it? We say 14.44%. Okay, 14.44%. This is the weighted average cost of capital after the proposal. That is, when the project is fully funded by debt, what happened to the weighted average cost of capital? It is 14.44%, whereas earlier the weighted average cost of capital is 13.14%. What happened here? Why weighted average cost of capital increased? It's because, see, you may be wondering, because the cost of debt is same in both the cases. It is 8%. But why weighted average cost of capital increased? It's because look at the cost of equity. Earlier it was only 16%, but now cost of equity increased to 20.89% because this business has attracted a lot of financial risk. So when there is a lot of financial risk, automatically the expectation of the equity shareholders will go up. That's what reflecting here, and as a result, weighted average cost of capital has also increased.
Thank you for watching this video. Hope you liked it. If you wish to learn more on this topic, do check our comprehensive online course. I have given the link in the description below. If you like this video lecture, do not forget to click on that like, share and subscribe button with bell icon.